Martin, I know that one thing you want to talk about was acquisitions because you've got some clients that are, looking to maybe acquire some competitors in their area. Tell us a little bit about those clients and their situations, and then let's work through what that process would be like for them to use the SBA to get a loan for the acquisition.
Most of them were almost theoretical, but we're having conversations. One's manufacturing. I had a text last night, actually, at 5 o'clock. Former clients trying to buy a company. I don't know anything about it, the company. But my questions about doing acquisitions are, one of my main question is, how do you value the business that's being acquired, right? What down would the owner have to put up in order to do it? Do you take pro forma? Do you accept cash flow estimates based on pro forma looking forward? Hey, when the two of us get together, I'm going to be able to do this, and this is where we go. Or does it have to be historic? And then how much, I'm throwing a lot into one question. How much down do the buyers, would they have to expect to have as a down payment? And then I've also heard that seller financed. In other words, if the seller agrees to take his money or her money over time, that can count toward the buyer's down payment. I don't know if that's true, but I've heard that. So that was a lot of things. Did you write them down, Gonzo? Because I don't remember what I said.
I'm going to take it in three tranches. So the first one, let's talk about how these are typically valued. So we called this segment of lending where SBA can play a meaningful role in a change of ownership. It's sort of Main Street lending. This is where private equity does not play, investment bankers don't play. It's too big for them. So it's called Main Street. And in Main Street lending, sort almost industry agnostic, there's a standard way that any business, it could be a car wash, it could be a dentist office, it could be a contractor, are valued. Now there's subtle changes based on the industry, but in part, here's how it's done. They're going to look at the 3-year historical seller discretionary earnings. Seller discretionary earnings is defined as the EBITDA of the business plus the W-2 salary of all of the sellers and any other discretionary expenses that have been run through the business. That creates the seller discretionary earnings. So let's say a business has $700,000 in EBITDA. The sellers have been paying themselves $300,000 in W-2 salary. Seller discretionary earnings is $1 million. That $1 million is then given what's called a market multiple. Market multiples in the Main Street lending arena are anywhere from 3 to 4x. Sometimes they can be higher or lower. So I'll give you an example of a CPA practice is going to have a smaller buyer pool because you have to be a CPA. So that's going to have a lower market multiple. But if it's something very simple to get into, maybe a restaurant where all you need is a license, it might have a higher multiple, but par for the course, we're seeing multiples sort of fall in that 3.5 range. So let's call it 3.5. So 3.5 multiple on the $1 million in seller discretionary earnings would result in an enterprise value of roughly $3.5 million. Now you notice I didn't even mention the assets coming over in the purchase or anything like that. That does get considered, but ultimately the lender and the buyer are looking at purchasing a stream of cash flows. That's ultimately what they're buying. The assets that come along for the ride are nice, but they're assets that are needed to generate that stream of cash flow. So that's a really succinct way of doing it. There's always going to be nuances and carve-outs. But so when we look at it, we're obviously looking at the debt capacity, but we are required by SBA to order a third-party appraisal on the business being acquired. And those appraisals, that's typically the main methodology they use. They might have 3 or 4 methodologies in the appraisal, but it ultimately gets weighted more heavily on the market multiple being applied to the seller discretionary earnings.
Beautiful. So 2 questions. One, if the assets are worth more than 3.5 times seller discretionary earnings, then it's an asset. Somebody's just buying some trucks, right? I know of a circumstance where one company had $40 million worth of rolling stock, and the business was generating multiples of earnings was like a lot less. I don't remember exactly. So, okay, I'm not selling the bit. You get the business, I'll sell you the trucks for $40 million. And then that would be a different loan program probably.
Yeah, those are a little bit more nuanced and difficult. I mean, ultimately, there's going to be a maximum amount of debt that the business can handle from a SBA term loan point of view, and that's going to be one ceiling. The other ceiling is going to be the appraised value of the business to include all the rolling stock. So there might be a big gap. You might have an appraiser come back and say, look, this business is worth $5 million. And so the maximum loan amount per SBA, 90% would be 4.5 million. But the bank might say, well, that's great and all, but we're running our cash flow analysis. The maximum debt this business can handle is only 4 million. So now there's $1 million gap between value and leverage. But then you also have the situation where maybe there's an extra $1 million in rolling stock. So you could have maybe a $2 million gap in how much debt and the ultimate purchase price of the business. And that's where seller carry and equity comes into play to fill those gaps.
Okay.
And if I can add there, the seller carry bag is a great, I don't know if I call it like insurance, but great way to incentivize, if there was misrepresentation or something in those lines when, you're now the seller really has an incentive to make sure that the business, is successful, because otherwise they won't get that money back, right? So recommending and encouraging, like Cashin was saying, just being thoughtful on not over leveraging the balance sheet, but also that seller carry back can add a lot of value to make sure that, in the future that person is picking up the phone and, you have questions and talking to that seller if something comes in the future, right? So and I want to share, now that we're in this topic, I wanted to share a statistic that I looked at before joining this. It's like, if you look at companies below 10 million in annual revenue, 47% of these companies are controlled by a founder that is 65 and older, and it's almost 50%. So there will be a lot of transition. And that's increasing now, right? But there will be a lot of transitioning happening now. Family-owned businesses, the son and daughter buying the business from, the founder. And SBA is a great product to meet that need. And anyway, I just thought it was a big number